What is going on, investors? Hopefully, you guys are doing well out there. Time to pick up the story of Uber Technologies. Can you buy the ride-sharing giant today, or should you wait for lower opportunities? Are lower prices coming for Uber? If you already have Uber shares, should you sell now or wait for the shares to rebound and move higher? The reason why we're going to be talking about this today, this company reported their earnings last week. We'll get into the numbers, take a look at all of the different things, including cash flows, including operating profits, and the balance sheet. We also have to take a look at the guidance, which came in a little bit below expectations, and that helped shares of Uber's decline. For the week, they were down over 5.8%. Over the last month, you've seen shares fall by about 11%, but you stretch it out to a longer time frame. Year to date, you're up about 9%, and over the last year, these things have rocketed up over 72%, although we are off of the 52-week high, which was up at about $82 per share. As we said, Q1 numbers came in. Revenue was $10.13 billion. That was good for 15.1% growth year over year. Beat expectations by about $40 million. When you start to look forward for Uber, that mid-teens growth rate is really where they're pegged at going forward. In fact, when the company reported their Q1 earnings, they give you a gross bookings number, which is essentially the total price that people pay for Uber rides and Uber Eats before they share the cut with the drivers. The expectation was for $40 billion in the upcoming Q2. Company says that they will probably fall somewhere short of that, maybe on the upside, just slightly better than that, with a total between $38.75 billion up to $40.25 billion. However, they say their adjusted EBITDA, which is essentially some adjusted profit number, will likely fall just above the $1.47 that Wall Street was estimating. Now, one of the reasons why this company has a high multiple is because shares have really rallied over the last year, and that has given it a 72 times forward multiple on its earnings for a company growing in the mid-teens. So you're certainly not getting this one at a bargain like maybe a year ago. But one of the reasons why you pay a big multiple for this one is because the company has really turned the corner from a financial perspective. $8.8 billion worth of revenue last year, all the way up to $10.1 billion. Your total costs and expenses did also scale up relatively well as well. $9.1 billion up to nearly 10, but look at your income from operations. You swung from a negative 262. So on a GAAP basis, dollar for dollar, you are now making $172 million income from operations. You flow down to net income. It spits out a negative number, but that doesn't tell the full story. You do have to come down here to cash flows because you do have a depreciation number that you have to factor in. We do have stock-based compensation as well. Company also has these accrued insurance reserves, so essentially setting money aside for different types of accidents and other types of insurance events that could potentially happen. Now, if they don't happen, that will impact profitability in a positive way, likely in a future quarter where they won't have to set aside so much cash for those reserves. So the company, as it gets better at predicting and maybe judging those types of events, could generate more cash flow. And we see over the last year, while the company's operating profits, certainly nothing to write home for, particularly for a company worth $140 billion. Also, net income, not necessarily something to write home for, considering it's negative $630 million or negative $660 million, all the way down to the bottom line. But your cash flows, after you factor in some of this stuff, really improved over the last year from $600 million up to $1.4 billion. Start annualizing a number like that out, and you get to $6 to $7 billion worth of operating cash flow. Now, understand that, again, the company is worth $140 billion, so we've got to continue to grow. But again, Wall Street is expecting kind of mid-teens growth, at least for the next year and a half or 2 years. One of the reasons why we focus on operating cash flows is that this company doesn't have a lot of money to spend on. It is simply a platform company, doesn't have a lot of infrastructure, property, plant, and equipment that it has to invest in. And so all of this operating cash flow at some point flows through to different other activities. They could buy back the shares at some point. They could pay a dividend. They could acquire other companies. They could reinvest in the business. And so that is the hope. And that is one of the reasons why you have such a large multiple on this company, is because that is the hope. You come down here to the balance sheet, slightly more cash than you did last year, about $5.7 billion. It is balanced off by about about $9.5 billion worth of long-term debt. Over the last year, you've added nearly $1 billion worth of net increase in cash. And again, this is just in a single quarter. So if you start to look out and say, well, Uber can repeat this quarter rather predictably and reliably, they're going to be adding $1 billion every 3 months to their cash balance sheet. And so that is where you start to make sense of this large market cap, which again is overvalued on paper, both from a price to sales, price to earnings basis. But if you had the vision to look forward 2 or 3 or 4 quarters, or even 2, 3, 4 years, well, that's when the magic starts happening, and that's when the valuation makes a lot more sense. So my recommendation, if you're already in these shares, and if you look at a volume profile, which is an indicator you can put up on your stocks using TradingView or other services out there, basically gives you a visual representation where a large amount of accumulation of Uber shares took place. And in this case, investors very smartly loaded up on Uber in kind of the $30 to $40 range. So there's a lot of people sitting on these shares. I don't think there's any concern about people that bought shares at this time. Maybe you skim a few off for profits, but there's nothing to be overly concerned about there. From a technical perspective, I know I've got a lot of lines on here. We'll maybe make sense of them a little bit. We're more or less in this channel that we've started back in June of 2022, making higher lows. It's gotten more steep more recently. You'd expect that to flatten out. That could potentially be what we're doing. We had all-time highs back here in February of 2021. Took us a long time to finally break out, make a new high. Oftentimes when you break to new highs, you do have a back test of the previous highs, and that's exactly what Uber has done. You could potentially buy shares at this level. That is because, and again, we're talking technically, ignoring fundamentals and valuation, that is because you are back testing the high. You're also back testing to the top of the channel. Both of those areas should act as some support level for Uber. While most people accumulated Uber in the $30 to $40 range, the people that have piled in more recently will likely step in at this range. If you do have a break of Uber at this $62 level, that's when it goes from a watch list stock, one that you're watching rather closely, to one you're watching very intently. In between 45 and 60 is where I would want to accumulate this one. You'd be accumulating it roughly in the middle of the upward channel that we're in. You should have some support level there. Barring any real weakness in the economy, I don't expect us to really see shares, at least in the shorter term, return to that kind of sub $45 level for Uber, where you're really getting shares for relatively cheaply. I think you do have to pay up for a company like this because the economics, the cash flow, and the business model all line up for a company that is just going to be spitting off large amounts of operating cash flow every single quarter. And while you do have to pay a premium for a share price for that one, eventually that cash will be deployed in some way or another for the company, whether it's through acquisition, whether through expansion of the business model, or potentially maybe share buybacks and dividends. Hopefully you guys enjoyed today's video. We'll be back again with more next week. Good luck with your investments.